Understanding the different types of credit. Are you asking yourself, what's an installment loan? What's revolving credit? And what's the difference between secured and unsecured credit? All the different types of credit can be confusing. To help clear up the mystery, let's break them down. There are three major types of credit. We call them the big three. They're revolving, installment, and open credit. When we talk about revolving credit, think of a MasterCard, Visa, or department store credit card. It's the type of credit you can use repeatedly, provided the account remains open, you're making on-time payments, and you have available credit on the account. For example, if you have a credit card with a credit limit of $1,000, you can charge up to that amount. Once you reach the credit limit, you can't charge again until your balance is below the limit. The amount of credit you have available depends on how much you owe. If you owe $750, you would have $250 left to spend. But if you pay the balance in full, you will again have $1,000 of credit available. The card issuer will charge interest on any outstanding balance you carry, and your monthly payments will vary depending on your balance. Since the monthly payments can go up or down, they can be harder to plan for in your budget. A home equity line of credit is another type of revolving credit. With a home equity loan, you can borrow against the value of your home up to an amount established by the lender. An installment loan is a lump sum of money that you agree to pay back by making a fixed monthly payment over a defined time frame. An auto loan, mortgage, student loan, or personal loan are examples of installment loans. When you get an installment loan, the financial institution charges interest that's typically spread out over the life of the loan. Payments are predictable, so you know exactly how much to budget. You'll qualify for lower interest rates and save money if you have a high credit score. Let's say someone with a low credit score borrows $15,000 for a car and pays it off over 5 years. The bank might charge an 18% interest rate for taking a higher risk to lend the money. That interest would add $7,854 to the loan, making the total amount you have to pay back $22,854. The monthly payment would be $381. But if that same person had a high credit score, they might qualify for a new car interest rate of 1.9%. They would only pay $736 in interest, making the total amount they have to pay back $15,736. The monthly payment would be $262. Having good credit could save over $7,000 in interest, and the monthly payment would be $119 less. Open credit is a combination of revolving and installment. The amount due each month usually varies, and the balance is due in full. Utilities like a monthly electric or water bill and some charge cards, such as American Express or gas card, can be open credit depending on the type of account the issuer establishes for you. Installment loans and revolving credit can be secured or unsecured. A secured loan means you are offering the lender collateral they can use to minimize their risk of extending you credit, such as a car, home, or other personal property. And with a secured credit card, the money you deposit into a savings account is typically equal to the amount of available credit on the card. Your deposit serves as the security. Unsecured debt is credit extended with no collateral requirements attached by the lender. Since the lender is taking a higher risk, you might have less favorable repayment terms and interest rates. Lenders like to see a mix of installment loans and revolving credit when considering your creditworthiness. And 10% of your credit score is based on having a healthy mix of the two. If you're new to the world of credit and trying to establish a credit history, a secured credit card or loan might help you begin building a healthy credit profile.